Imagine receiving £100,000. It might be the reward for years of saving, a payout at the end of a career, or maybe an unexpected inheritance. It's a serious amount of money, big enough to make a real difference to your future, but also big enough to set you back significantly if it's handled the wrong way. Now, when people talk about investing, they usually focus on the perfect strategy, but today we're going to do something different. We're going to start with the mistakes. And to do that, we're going to follow the story of James, a 35-year-old who's just inherited £100,000 from his uncle. Now, James isn't reckless. He's not gambling his money away or making wild bets. He's an intelligent, informed investor who's convinced he knows exactly what he's doing. And yet, within just a few months, he managed to make almost every common mistake people make when investing a large sum of money. Mistakes that might not seem like a big deal on their own, but that together can seriously damage your returns, your peace of mind, and your long-term goals. Hello, I'm Brian, and in today's video with MoneyFarm, we're going to look at how not to invest £100,000, walking through James's decisions and understanding why, even with the best intentions, it's so easy to be led astray by emotion, by hype, or by false confidence. So let's dive in. So as we said, James is 35 and a few weeks ago he inherited £100,000 from his uncle. James is a regular person with a regular job and he's never managed an amount of money like this before. But he's also got his head screwed on and he knows that a sum like this, handled well, could change a lot about his financial future. So he starts doing his research. He watches a few videos on YouTube, reads a few articles and signs up for a couple of financial newsletters. And what he keeps hearing tends to circle back to the same couple of ideas. Artificial intelligence is changing the world, and the shift to clean energy is unstoppable. So he thinks it over for a few weeks, and eventually he's convinced. These are the two big trends of the coming decades, and they're both worth backing. He reads a bit more and discovers he can invest in both of these themes fairly easily. So he takes his £100,000 and splits it in two. £50,000 goes into a thematic ETF focused on AI and tech, and £50,000 goes into an ETF dedicated to the energy transition like solar, wind, and battery companies. With two ETFs, he's covered both trends he'd identified and feels at peace with it because, as far as he's concerned, this was a considered decision that will pay off over time. And in a way, he isn't entirely wrong. The trends he spotted are real. AI is reshaping entire industries, and the energy transition is backed by real policy, real capital, and real needs. But his strategy still has some big problems. And the first one isn't about what he chose, it's about how he chose it. Because what James has built isn't a portfolio, it's a bet. Think about it. His entire £100,000 rests on a single idea that these two sectors will grow in the time frame he imagines and in the way he imagines. The problem is, things don't always go the way we expect, and it only takes one variable to behave differently. Maybe a new piece of European regulation on renewables, or a slowdown in AI investment for that £100,000 to take a serious hit. As it stands, his portfolio is completely exposed, and every bit of bad news about tech or clean energy becomes his problem. Well, this mistake James has made has a name, and it's called concentration. In investing, concentration is when too much of your money is tied to a single asset, a single sector, or, as in James's case, a single investment idea. A rough rule of thumb: if one sector, theme, or asset makes up more than 20 to 25% of your portfolio, you're up in concentration territory already. And don't get me wrong, the problem isn't backing an idea you believe in. The problem is that when that idea takes up your whole portfolio, you've got no room for error. If you're right, great, but if you're wrong, or even if you're right just on a different timeline than you imagined, the damage is total because there's nothing else in the portfolio to hold the line. Concentration is the exact opposite of diversification, which is the basic principle every solid portfolio should be built on. Diversification means spreading your money across different assets, different sectors, and different parts of the world, so that when something goes wrong, it doesn't all go wrong at once. And to be clear, diversification doesn't make that risk disappear, but it stops your entire future from resting on a single thing going right. Well, as you can imagine, James didn't do that. He didn't build a balanced portfolio that can absorb different scenarios. He built a concentrated bet on one conviction, which he treated as an inevitable certainty. And in markets, certainties are the most dangerous thing there is. In the first few months after investing, James is happy. The market is on his side, prices are rising, and what looked like a gamble is starting to look more and more like a smart move. Then, all of a sudden, volatility arrives. It's not a crash, and it's not a systemic crisis. It's a perfectly normal market correction. First, minus 8%, then minus 12%, then minus 15%. Well, for anyone who knows the markets, this is nothing out of the ordinary. But James hadn't factored this in, or rather, he hadn't decided in advance how he'd react if it happened. So he starts checking his portfolio obsessively. He's no longer comparing it to his long-term goals, he's comparing it to the price he paid. And he notices that the £100,000 that had climbed to £108,000 in those first few months is now worth £84,000. For James, that gap stops looking like a normal fluctuation and starts looking like a loss he has to recover at all costs. And from that moment on, every decision becomes a reaction. One day he's thinking about selling everything to limit the damage. The next day he changes his mind, scared of getting out at exactly the wrong moment. Then he reads that this could be the perfect time to buy more. And then he reads the smart thing is to sit tight and do nothing. Overwhelmed by all of it, he decides to just stop looking and doesn't check anything for a couple of months until things settle down. Once the storm has passed, James sits down to think it through and realizes his mistake. He'd never decided in advance how he'd behave when the market got rocky. So he decides he needs to diversify and adds a few positions. He buys a second ETF on global tech, then one on large cap US companies, then one on cybersecurity. Now his portfolio is made up of 5 different instruments instead of 2, and James feels more protected. The problem is that all 5 of these move in the same direction because they all depend on the same things: the same economic cycle, the same interest rates, and the same handful of big tech companies that dominate every one of those indexes, which means that when the next bout of instability comes, his portfolio behaves exactly as it did before. If you own an AI ETF, a US large cap ETF, and a cybersecurity ETF, you probably own Nvidia 3 times over. And that's not diversification, that's concentration with extra steps. So James has acted thinking he's improved things, but all he's actually done is add complexity without changing how his investment would respond to the next round of volatility. And the reason is that he hasn't mixed different sectors, geographies, and asset classes. He's just added more instruments that don't change the substance of his asset allocation and don't reduce the real risk in his portfolio. Now, this is one of the most common traps there is, confusing having more instruments in the portfolio with being diversified. Owning 5 things instead of 2 feels safer, but if all 5 rise and fall together, you don't have 5 different investments. You really just have one, bought 5 times over. Now at this point, James has a new idea. If his portfolio keeps moving the same way regardless, then surely the solution is simple. Just work out when the market is about to fall, get out before the drop, and then climb back in once it's hit the bottom, pocketing the difference. The idea basically is that if he gets the timing right, he can only win, and his inheritance will soon turn into something even bigger. So he starts following everything closely: central bank statements, inflation figures, and the quarterly results of the big tech companies, and he notes it all down. 2 months later, the moment James has been waiting for arrives. The Bank of England hints that rates will stay higher for longer than expected, and a couple of big tech names report results below forecast. James looks at his notes, looks at the charts, and convinces himself this is the moment to get out. So he sells everything and moves his money into cash. Just as he'd predicted, the market falls 7% in a matter of days. All of a sudden, James feels like a genius. But now he has to decide when to get back in, because while it's true the market has fallen, he's not convinced it's hit the bottom yet. He notes down it's better to wait a few more weeks, see if it drops a little further, and then climb back in at just the right moment. The next day though, the market bounces 9%. The day after, it bounces again, and within a week, it's recovered almost the entire drop. James is stuck. He'd promised himself he'd wait a few weeks, but in no time, the market has recovered, and getting back in now would mean buying at almost exactly the price he sold at. So he waits a bit longer, thinking that maybe it's just a technical bounce, and what if it starts falling again soon? Meanwhile, the market keeps climbing, reaching levels further and further from the point where James got out. In the end, he does get back in, but he's missed the best days of the recovery, and those are exactly the days that, over a long time horizon, make the difference between a good return and a mediocre one. This is sometimes called waiting for the all clear, and the cruel irony is that the all clear never really comes. By the time things feel safe, the recovery has already happened. Now, this is the structural problem with trying to time the market, which is essentially what James tried to do. Timing the market, in fact, doesn't require you to get just one decision right. but two. First, you have to know when to get out, but then you have to know when to get back in again. And if you get just one of those wrong, you risk being out of the market during the very moments that matter the most. The reason is, markets don't move in a neat, predictable line. They react to an enormous combination of things, like economic data, central bank decisions, investor sentiment, and geopolitical events, and they often do it fast and in counterintuitive ways. And that's exactly why people sitting on the sidelines waiting for the perfect moment tend to miss the sharpest recoveries, because they arrive when you least expect them and where the temptation to wait just a little longer is strongest, and the numbers back this up. If we look at the 20 years between 2005 and 2025, an investor who stayed invested in the S&P 500 for the entire period would have turned $10,000 into around $66,000. But if they'd been out the market for just 10 of the best days of those 20 years, they'd have ended up with less than half, around $29,000. So, in a nutshell, the strongest rebounds arrive right after the deepest drops, precisely when, like James, you've convinced yourself it's better to wait just a little bit longer. Now, if we look at James's decisions altogether, a clear thread runs through them. He never ran short of information. He ran short of method. He put everything on a single idea, turning an investment into a bet. He reacted emotionally to volatility instead of planning for it. He thought he was diversifying by adding instruments without realizing they were all moving together, and he tried to beat the market with timing, achieving exact opposite of what he intended. Each of these mistakes on its own might seem manageable. Together, though, they build a path where the odds of a good outcome shrink with every step. A more solid approach would have called for a few concrete things. First, defining your goals and your time horizon. £100,000 you need in 3 years calls for a completely different strategy than £100,000 you can leave to work for 15 years. And without that basic distinction, every other choice risks being incoherent. This is also where James got something else wrong, without us ever naming it. He never thought about risk in the right way, because the right level of risk isn't the lowest one or the highest, it's the one that matches your time horizon and how comfortable you actually are when markets move. Second, building real diversification, so spreading your money across asset classes, geographies, and risk levels, not across instruments that all move in the same direction. And third, setting the rules of the game in advance, how you'll behave if there's a downturn, when you'll rebalance, what thresholds you'll respect, so the decisions get made according to a plan you set with a cool head, not under emotional pressure in the moment. Now, if you've been following along, you might feel a little overwhelmed by this point. Define your goals, get your risk level right, build real diversification across asset classes and geographies, set your rules in advance and stick to them when the market tests your nerve. It's a lot, and that's before you've placed a single trade. For some people, that's part of the appeal. They enjoy doing the research, building the portfolio themselves, and staying hands-on. And if that's you, it's absolutely possible to do all of this on your own through a platform like MoneyFarm that gives you access to the investments you want. But plenty of people don't want to make all these decisions themselves. They don't want to spend their evenings choosing between asset classes, worrying about whether they've diversified properly, or talking themselves out of a panic sell at the worst possible moment. But if that sounds more like you, that's exactly where something like MoneyFarm's managed portfolios come in. With a managed portfolio, you set your goals and your attitude to risk, and you're matched to a globally diversified portfolio built across asset classes and regions at one of 7 risk levels that's professionally managed and rebalanced for you. You can also hold it inside a stocks and shares ISA, so it's working tax efficiently from day one. And as your wealth grows, you get access to real human support, right up to a dedicated wealth manager to help you stay the course. Because that really is the thing James kept getting wrong. Almost every one of his mistakes came from doing something and reacting, whereas most of the time, when the market moves and the urge to act kicks in, the best move is to sit tight and go with your plan. So there you have it. Every mistake you should avoid when investing £100,000. If you found this video useful, please subscribe to the channel. And if you've any questions, drop a comment below. And as always, I look forward to seeing you in the next video. Bye bye for now.